All right, good morning to all. It is February 2nd, and we are continuing our sessions, which are coming at us fast and furious. Our goal is really to do these sessions really once every 2 weeks, and we're kind of hitting that metric now. We have some really good ones that are coming up, one on privacy, which I'm excited for, one on title insurance fraud, which is also going to be exciting.
No one cares about title insurance. It's not in the news. Why are you talking about it?
So we are going to have some fun in the coming weeks for sure. Just a couple of things. First off, like all of our sessions, these videos are public. Our group is private, and that's only our professionals, but these sessions are broadcast on a lot of channels and anyone can watch them, so be advised of that. We're now going forward, and we're now trying for 12,000 members for our group, so please invite professionals that you know that want to join to come on board. Without further ado, I want to turn our attention to the order of the day. Elan works for Mortgage Outlet, which is one of the largest mortgage brokerages in the city. It is the case.
Country. One of the largest brokerages in the country. Go on.
Okay. Thank you very much. There you go.
Sorry, I feel like it's working. Yeah.
It is the case that where people are starting to strain under higher interest rates. In fact, they have been for some time. It is the case that after people stop paying their taxes, their municipal taxes, and stop paying other things and lower their expenses, eventually they get to the heart of the matter. The biggest payment they have is their mortgage payment, and oftentimes they cannot make it. What happens when that happens? What happens when you see that coming up? Well, certainly if there is no money, and if you're at a point where enforcement proceedings have begun, you're going to speak to a lawyer, you may even speak to a trustee. We've spoken to some of them in the past. But preemptively realizing that you're in trouble and starting to preemptively deal with a mortgage agent is an important component of dealing with the stress in today's markets. And there are strategies that a mortgage broker can bring to the table to actually assist yourself or your clients in that regard. And that's what Elan is here to speak to us about today. Elan, without further ado, I'm going to turn it over to you, and we can go forward.
Okay, so it's funny because when Mark asked me to do this, he said, talk about help. I cannot pay my mortgage. Now what? And as he was saying, it's very important to distinguish, and it's one of the key themes of this presentation. The farther you go into default, the more it's like talk to the lawyer. So one of the key themes, and I'm going to talk about this a lot, is speaking early and often when you have concerns and fears. So I'm going to jump right in. Thank you everyone for joining. I always start off with 30 seconds about myself because, you're going to be investing your time in it and you want to know, like, who is this guy and does he actually know what he's talking about? So very briefly, I'm the co-founder of Mortgage Outlet. I did my BBA and MBA at the Schulich School of Business, where I was in the top 3% of my graduating class. Mortgage Outlet funds over $1 billion a year of mortgages. So again, hopefully I know what I'm talking about. I'm frequently quoted in the Globe and Mail. I speak at the Toronto Real Estate Board, et cetera, et cetera. I work realtor hours. That's my little joke, because I do understand that the business is not 9 to 5. And I've even been on like the national news, CP24, many times. So the key takeaway is I'm awesome and I know what I'm talking about. So let's move on. So I actually wanted to spend a little bit of time about talking about the context of what's going on to really crystallize. Everyone here is a professional, whether you're, a lawyer, a realtor, a mortgage professional, but I think it's important. I like to crystallize it so that we're all looking at things with the same kind of lens. So I've been thinking about this more and more, and I'm trying to be more deliberate here, but I want to rewind to July 15th, 2020. when the Bank of Canada said, if you've got a mortgage or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time. And, when the Bank of Canada says something, the governor of the Bank of Canada, it's not just some random newspaper reporter or even, a deputy economist from a big bank. It's the Bank of Canada. So they need to choose their words very carefully and precisely, and that's a big part of the role. And then I'm going to fast forward a couple months later, and the Bank of Canada said, as the economy recuperates, it will continue to require extraordinary monetary policy support. The Governing Council will hold the policy interest rate at the effective lower bound until the slack is absorbed so that 2% inflation is achieved. In our current projection, this does not happen until 2023. So there are two statements here, and we can go into the nuance, but it's basically they said 2023 rates are going to stay low. And the headline is 2023. And again, we can get into the nuance. The Bank of Canada, in my opinion, really, really hurt Canadians, really, maybe more so than any other political or government entity in the last few years, arguably. People are really struggling right now. And a lot of it is based on this guidance. And again, these are their words, not mine. But again, this is part of the context that I want to set. So again, I guess a long time is subjective. Well, rates were 2.45, low, pandemic. They started to go up, and then they were at 4.7. And then guess what? Now they're, the prime rate of Canada is 6.7%, which is, one of the highest rates, both in terms of speed. And if you look at it on an absolute and relative basis, when you're starting off at such a low rate and then rates go up, the impact is profound. So again, I think that they just really hurt people. I mean, there's no other way to say it. They really, really, people are stressed. They're physically stressed. They're struggling. And prime is at 6.7. It actually went up. So let's now talk about the impact to realtors and home buyers and sort of the market. Let's talk into that a little bit. And I do like presenting in person because I can see. But if you have any questions, I'm going to save some time for questions as well. So let's talk about nerdy mortgage stuff first, which I love. So we've all heard fixed rates, fixed variable, We kind of know what they are. If you're in this forum, there's a 99% chance you know what they are. But there actually is a very subtle and important nuance. And the nuance is that there's two types of variable rate mortgages. Some are called variable rate mortgages and some are called adjustable rate mortgages. And in Canada, we have five big banks, and four of them use one approach for variable rate mortgages, and Scotia and some of the other, medium and smaller tier lenders use what Scotia does in terms of adjustable rate mortgage. So let's talk about that, because again, this is stuff that really never came up. We've been in a steady or declining interest rate environment for years and years and years. This hasn't really had any real world practical implications. But let's say, a year ago, you got a Scotia mortgage and your payment was $2,000. And then interest rates went up and they went up and they went up and they went up and they went up as they did. Well, with Scotiabank would say, hey, Elan, your payment is now $2,200. Then a month later, hey, Elan, rates went up again. Your payment is $2,300. Then a month later, hey, Elan, rates went up again. Your payment is $2,500. So Scotia was raising rates every time. And that, like everything in life, I guess, there's sort of advantages and disadvantages. The advantages is that you're kind of staying on top of debt. The disadvantages, you are getting really stressed out and really reminded, and your cash flow is really disappearing. But to contrast that, the other four big banks, and again, there are other lenders, it's always you have to check with your lender, they kept your payment the same. So as an example, your payment was $2,000. and let's say at the beginning of the year, $1,000 went to interest and 1,000 went to principal. And then let's say 6 months later, rates have gone up. Well, maybe $1,500 was interest and 500 was principal. And then a few months later, interest rates went up, and then $1,900 was interest and only $100 was principal. But the good news is that at least from a month in and month out basis, you could afford it because it was $2,000 a month. But then we get even more nerdy. So let's talk about the more nerdiest. So you probably have heard this word in the news a lot, but the word is trigger rate. And let's look at my example. So again, earlier in the year, prime was at 2.45%. I had a really good mortgage. My mortgage was prime -1. So prime -1 is 1.45%. My payment was $2,005. The $2,005 was broken out into interest and principal. And later in the year, rates went up a lot. And all of a sudden, my payment is still $2,005, but $1,800 was interest and $201 is principal. And I'm going to pause here and tell a 30-second story. I was fortunate to hear the CEO and founder of Capital One many years ago. I think CEOs are generally not that good, but I think he's a visionary in the realm of Steve Jobs and that kind of level CEO. And he came to Canada and he said, cash flow and liquidity is like oxygen. You can't have it 98% of the time. So in this example here, even though it's uncomfortable, it's crappy, it's whatever, that you're paying so much more interest, on a month in, month out basis, you're paying your bills. You can afford your bills. $2,005, $2,005. You're not optimal, but you're certainly like living within your cash flow, that liquidity that he was talking about. But then obviously rates kept going up and up and up. And again, your payment was $2,005, but all of a sudden the mathematical interest rate was $2,048, and you were actually reducing your principal. So this is called the trigger rate, which again, every lender has very specific wording and scenarios and what have you. But on a very conceptual level, what it means is that your monthly payment in this example of $2,005 is not even covering your interest. And different banks have very different strategies on this. Other banks are going to be like, oh, don't worry, it's cool. Like, you'll deal with it in 3 years. We'll talk about it when you're up for renewal. Other banks are like, yeah, this is not cool. We need to increase your payment today. So there's a lot of noise, a lot of confusion. Again, every lender has different policy, but this is part of the context of how, we start off here where rates are low and you're saving money and all this is great. And then rates skyrocket, which is not so good. And then you're in a variable rate mortgage. So your cash flow is stable, but then all of a sudden, even your cash flow isn't stable. So the context has massively changed over recent memory. Now I want to use a real world example here. So similar to what we had there. So let's say in 2022, my interest rate was 1.15% variable. My payment was $1,918 a month. Well, I always like to look at the amortization or the allocation of that $1,900 a month, or the $1,918. Well, in month one, M1 stands for month one, because as an amortizing mortgage, the ratio of interest and principal changes every month. But in month one, $1,440 of your monthly payment, i.e. 75% of every dollar you're spending, is going right back into your pocket. Like, this is incredible. This is almost like you're living mortgage free. You're paying $2,000, $1,900 for your mortgage, and $1,440 is going right back into your pocket that day. So these are like amazing times as the homeowner and as someone who's paying rent. Someone who's paying a mortgage. But then let's fast forward to 2023. Let's say, and again, it depends on many factors. I put in 5.7% as the interest rate. Now prime is at 6.7. So prime -1, which is a pretty good rate on a variable rate is 5.7. So let's say you have prime minus 1. All of a sudden, your monthly payment is now 31.10. Your interest is 23.47. So in other words, your interest cost is more than what your payment was previously. Now, I like to use colorful analogies, but the difference in your monthly payment here is around $1,200 a month. That's a lot of money. Okay. A lot of people are paycheck to paycheck. A lot of people are moderate or middle class. $1,000 or $1,200 a month on a $500,000 mortgage is massive. And I have a name for this. I call this a Range Rover lease. And basically, this is the mortgage equivalent of me talking to all my clients and saying, how's your debt? How's your payments? And they're like, oh, good. You know, inflation, things are expensive. And I'm like, great. By the way, you need to lease a Range Rover for $1,200 a month. Think how insane that is to be like, well, I can't afford a Range Rover for $1,200 a month. They're not even getting a Range Rover here. So again, people are really hurting, and this is part of the context. Now, the question is, and again, it really depends on whether you're a homeowner, whether you're an investor, or whether you're planning to buy. So if we look at it as a home buyer, you know, and I have this scenario now, I had a client, they bought a property in Oshawa for $1 million last February. They put 20% down. Let's say they had an interest rate of 2.99% at the time. Well, their monthly payment was $33.60 per month. But now, and again, depending on the area, depending on the what's going on, I do think the market has picked up a lot in the last couple of weeks. But let's say December, early January, maybe in Oshawa, that house would be $200,000 less. So even though the interest rates are higher, and by the way, this rate is 5.5, rates have actually come down there. But even though the interest rate is higher, you're saving $200,000 right off the top. So I would argue that as a home buyer, it's actually much better to buy now. You could do a home inspection. You can take your time. So in one context, it's actually better for the home buyer. But let's talk about homeowners, because they're the ones that are really kind of feeling this. The other thing briefly on a home buyer, and this is important for realtors, but it's also really good context for lawyers and other professionals. If I look at mortgage rates here and I look at this 2% rate, so let's say, you know, rates were 2%. A lot of buyers would say, Elan, I can only afford $2,500 a month as my monthly payment. And I said, okay, well, rates are 2% today. You could borrow $590,000. And if you do, your monthly payment will be $2,500. But now if interest rates are 5%, you can only borrow $430,000. So you can borrow $160,000 less today if you're comfortable with that $2,500 monthly payment. I can share the slides and the recording. I will let Mark do it. Thank you. So you can see here that, you know, a year ago, I could say, yeah, you could get a $590,000 mortgage and it will fit into your $2,500 budget. But today, if the rate is 5%, you know, you could only borrow $430,000. But again, the good news is that, well, I guess good, depending on your scenario, prices are down. Maybe not 20% anymore. Again, Toronto versus suburbs is different, condos versus assignments versus all that. So it's very different. So let's talk about solutions and, you know, what can a mortgage broker do? And ultimately, you know, what can a lawyer do and all of that good stuff. So a big part of how I run my business is what I call, you know, the sunscreen versus afterburn lotion. And it's very simple. It's much easier to put sunscreen on than it is to go out, have a great day at the beach and have a sunburn for the next 4 days and not be able to move. So as much as you can, as a homeowner, as a lawyer, as a mortgage broker, as a realtor, focus on prevention. Okay, once we're in default and past due and letters are coming from lawyers, potentially and likely it's too late. But if we can get there early, there's a lot of things we can do. And on a similar note, if I were to leave people with one piece of advice, and I do try to crystallize things into one very clear theme, don't put your head in the sand. The more you ignore it, the worse it's going to get. The earlier you talk with, your family, your realtor, your, lawyer, whatever it is, your family, the better things are. Like, this is the answer to the question that we are asking today. And I'll get more tactical. But again, sunscreen versus afterburn, and don't put your head in the sand. Okay, so the first thing that I advise my clients is, don't panic. Like, we're going to work through this. I'm on side with you. You're going to get your team of professionals. Don't make any rash decisions. The worst thing, when I say don't panic, that another way of saying that, and that's the second, image here, don't lock in with your bank. You're going to panic. You're going to call your bank. They're going to lock you in. You're their prisoner. I can't help you anymore. But there's a very big nuance here. Don't lock in with your bank, but the third image, go to your bank, go to your lender, and ask them, what are your options? Don't walk into those options. Explore those options. Because sometimes your lender might give you a really good offer, and I will look at it and say, you know what, that's a great offer, take it. Or they might play games with you and treat you like a clown. And I'll say, oh, they're playing games with you, or they're not actually solving the problem, or, that doesn't make sense, or there's actually a tax issue. Talk with your accountant. So talk with your bank, but don't talk in a panicked environment where you lock in. Get your options. Understand. And you should be very open. I can't afford my payments. This is really stressful for me. What can I do? Ask them. So that's the first thing. Always start with your current lender so you know what's on the table. The next thing we do, or that I look at, is kind of two things. So again, there's a lot of realtors on here. Professionals might get a bonus, your Christmas bonus, your annual bonus. Can you consider putting it into your mortgage? You get a $10,000, $20,000 bonus. Maybe, it's kind of funny, but they call it the Canadian strategy. If you get a $12,000 bonus and you can afford it, put $12,000 in your RSPs. You get a $5,000 tax refund. Take the $5,000 and put it in your mortgage. Now, again, I'm going to happily qualify what I'm saying. Talk to your accountant, talk to your lawyer. This is generic, opinion, but that is not a bad idea. The other thing you can do, among many, is switch your payment frequency. So if you're paying monthly, consider paying bi-weekly. And even sometimes for a married couple, maybe they're paid on opposite weeks. It might even be a good idea to pay weekly. And the reason I like weekly in certain circumstances is, like, money comes in from the husband, goes out. Money comes in from the wife the next week, goes out. You're paying your mortgage weekly. And by paying it weekly, it's also easier for your cash flow, because money in, money out, money in, money out, money in, money out. When you pay monthly, there's a big burst of money leaving. So your payment frequency does help with your overall interest cost. What is an example of a good offer? So that's a great question. There's a very simple answer there. 2 words: it depends. It depends on your situation, but it also depends on your problems. So I'm going to go through some context, and then we'll go back to that question. That's a really good question. So I love the nerdy stuff. So I want to share one of my favorite terms here, and maybe I have to move it. I don't know if you can see it here. Hang on. It's kind of cut off here, but this is like a super nerdy mortgage word, or it's not a mortgage word. It's actually an investment word, but it applies to mortgages. So let's just take a little pause here and enjoy the nerdiness. Okay, so what does this mean? And this is really important. So let's say I give you $10,000. You can put it into the stock market. And if you put it into the stock market, you could get a 10% return on your investment, but you could also lose 10%. So there's risk involved there, but there's a reward, maybe again, 5, 10, 15% growth or profit, but also there's a risk that you might lose 5, 10, 20, 30%. Now, let's just assume that you make 10% return on your money, which is obviously not guaranteed. Well, you're going to pay tax on that 10%. And again, depending on your tax structure, it could be anywhere from 0, but it could be 40% tax rate, maybe even 50%. So on an after-tax basis, factoring in the risk, the term is after-tax risk-adjusted rate of return. If you, I thought I had the exact term in here. Let me put it in here. After-tax risk-adjusted rate of return. If you have a bonus from your work and you put it into your mortgage and your rate is 5.5%, you're getting a guaranteed rate of 5.5% return on your mortgage. And there's no risk because it's a payment, like there's no volatility in terms of the principal amount, and it's after tax dollars. So if you are in a fortunate position where you can afford it, if the interest rate was 1%, I wouldn't suggest that people, go and make a prepayment. But if your rate is 5, 6%, it might be one of the best things you could do, especially on a risk-adjusted after-tax basis. Okay, again, what should I do now if I have a variable rate mortgage? So, some of the conversations I'm having with my clients, they've been at their job for 3, 4 years. They're an account executive. There's some kind of assistant manager, whatever it is. Well, if they're making $50,000 a year and they've been at their job for 3 years, there's definitely an opportunity to explore maybe getting a job that pays, 60, 65, 70,000 a year. It's not, very simple. What is income? It's your revenue or your money coming in, your cash coming in, minus your expenses. So if you've got a job that's paying you 50 as an assistant manager, and you can get a job where you're a manager and it pays you 20,000 more, 15,000 more, that can be a big opportunity. A lot of my clients, again, especially ones struggling, they're doing side hustles. It can be anything from driving Uber. It could be, doing kids' birthday parties. It could be, doing digital marketing consulting, whatever it is, virtual assistant. But people, again, it's not an easy time. And these are some things that people are doing. People are renting out their basement, or they're even getting roommates. Some first-time buyers, if they got a 1-bedroom plus den, they're getting a roommate. And obviously this isn't ideal, but this is the things that people are doing to grow the revenue side of their income statement, of their sort of cash flow. And this isn't a fun message to deliver, but this is also a practical message that people are doing. Okay, most importantly, and my favorite tactic is speaking with a mortgage broker and do the math. So there was a question here, which is a great question, about how do you know if your bank gives you a good offer? And the answer is it depends. And what does it depend on? What if they give you a very low interest rate, but you still have a car loan and credit card debt, and you owe some taxes and all this and that? Even though you've got a low mortgage rate, your credit card debt is 20%, your car loan is at 7%, your CRA arrears are, 9 to 15, 18%. So you don't want to look at the rate in a very limited capacity of your mortgage. You want to look at it holistically. Now, let me give you another example. Let's say that you have no debt and they give you an amazing rate, but they're not willing to adjust the amortization. So in other words, you got a 25-year amortization 5 years ago. Now there's a 20-year amortization remaining because 5 years have gone by. They're offering you a renewal at an amazing rate, but there's a 20-year amortization and your monthly payment is $3,000 a month. And you say to me, Elan, like, I'm going to be stressed out every month if my mortgage is $3,000. And I might say, well, they gave you a really, really good rate. I can get your payment down to $2,000 a month, but the interest rate is going to be higher. And that's a decision that the borrower needs to make. Now, again, in the spirit of my colorful analogies, everyone wants, a car that looks like a Ferrari, that's priced like a Kia, that can go off-road like a Jeep, and that can, seat 7 like a minivan. But that doesn't exist, right? We have to pick the things that are most important to us. And a lot of times, and I don't blame them, but a lot of times, I have a close friend, and she's actually a financial analyst. She had a renewal offer from CIBC, and I was like, okay, they gave you a good rate, but you've got this and this and this and this, and you're doing this. Why would you do that? Why wouldn't you do this? And within 5 minutes, she's like, yeah, I mean, I don't know why I was looking only at the rate. Going back to the CEO's comments, cash flow and liquidity is like oxygen. Why would you want to spend the next 5 years of your life stressed out? I remember, many, many years ago, this is before I got married. I went out with some couples with my wife, and before she was my wife, and some other couples. And the other couple, this is like a long time ago, the other couple had just purchased a house in like Burlington or something. And like, this is, what the hell is Burlington? Sorry, no disrespect. But at the time when you lived in Toronto, again, very, very long ago, you'd never buy. And they were calculating whether they could afford to buy dessert. Now, half of me massively applauds their discipline in staying true to their budget. But the other half of me is like, are you guys crazy? Like, that's how you're going to live your life? Like debating whether you should buy a dessert. So again, you're looking at the rate, the cash flow, your other debt, what your goals are. Oh, you know what? I actually want to take out $200,000 and renovate my basement so that I can rent it out. Well, that $200,000 will increase your monthly payment by $1,000 a month or $1,200 a month. But then you can rent out your basement for $1,900 a month, resulting in $700 of net cash flow, right? So what are your goals here? Another one that, I always like to give options, and my role is to give options, and it's the client's role to decide. But do we get your parents involved? And sometimes a parent will co-sign, and I certainly understand, pride. I understand, I'm independent, I'm this, I'm that. But, I'll talk for myself only. But if I had the choice of having, a not great mortgage that costs me a lot of money, or asking my parents to co-sign and saving a shit ton of money, I would just suck up my pride and ask them. But everyone is different. And again, my role is not to understand your family dynamic. My role, and a good mortgage broker's role, is to do the math, highlight the scenarios, and then you decide along with your family. Another one, as we get further along, closer to the lawyer, and again, as we get to the lawyer, my ability to help diminishes. But if there's an existing lender, generally speaking, a good mortgage broker will know that lender or will have contacts with that lender. So the mortgage broker can step in, and not as a lawyer, but as a relational mortgage broker, and say, listen, I'm helping Tony with their mortgage. They're definitely struggling. I'm telling you right now that I'm putting their file together. I feel really good about it. I would really appreciate if you could just kind of, ease up for a couple of weeks and let me get organized and obviously me, I'm Elan, I'm the owner, and give us a little bit of room so that we can all get what we want. And especially banks and credit unions, they're not in, they don't want to evict you, they don't want to power sale you, foreclose on you, all of the, like, that's really bad press for them. So they will do what they can. Now, again, part of it is whether it's a bank, and especially smaller lenders, if you ignore smaller lenders especially, they get really pissed off. If you go to a smaller lender and you're like, listen, I just got fired, but I got another job and I'm starting in a week, can you give me a 2 weeks? And you're very upfront about it, right? If you're very upfront about it, I'm not saying they're going to give you everything, but the good private lenders and middle tier lenders will listen and will try to accommodate. But if you don't tell them and you don't answer their phone and you block their call, they're going right to the lawyer for aggressive options. So again, don't put your hand in the sand, communicate. And again, leverage your relationship with your existing lender. Now, going back to that question, how do you know it's a good offer? Well, if they're offering you, actually, this is another really important offer. Let's say they offer you 5.29% to lock in, and I can offer you 4.89%. Is that a good deal? Let me ask the question to the group. I like presenting in person, but I love to like get some engagement. But is that a good deal if I can get the person 4.89%? It depends. I mean, exactly. What is it? Okay, what does it depend on? Let's go further. 100% it depends. Let's say the terms are equal. Life changes, yeah. What other debt? Yeah, so the one that I was particularly looking at, amazing. Does it solve cash flow? What other debt do you have? If they're just going to renew you at a lower rate, or sorry, at a slightly higher rate, but you have 40,000 of credit card debt, or you have a car loan that's $1,000 a month, or you owe CRA, or you're struggling financially, it's not solving the oxygen problem. The oxygen problem is the month in, month out, you need oxygen 100% of the time. So number one, but here's the other question, right? What's the penalty? What if the interest cost, I can save you? Yeah, thank you, Paolo. What is the interest cost? Now, if I can save you $9,000 of interest, but the penalty is $14,000, and that's the only factor that's important to you, then you don't switch. But if I can save you $28,000 in interest and there's a $4,000 penalty, then you switch, right? So again, all of these factors come into play. And that kind of leads to the next slide, which is, a good mortgage broker starts with a deep diagnosis. You would never go to a surgeon if you needed knee surgery and the knee surgeon, the orthopedic surgeon, didn't ask you for MRI, EKG, blood pressure, blood type, and they just said, hey, let's go to the operating room. I would hope that you'd say, like, don't you want to do some tests on me first? And it's the same thing with mortgages. I don't want to find out in the middle of your mortgage that you're divorced and you have US student loans and you owed CRA money and you were renting out your basement, but it's actually your mom who's the tenant and she hasn't really been paying you the last 3 months. That's not how you do it. Everything has to be ready to go. And again, the example is, imagine you were doing knee surgery and the surgeon found out in the middle of the operation that you're allergic to penicillin. I don't want my surgeon to find out I'm allergic to penicillin in the middle of the operation. But this data, this diagnosis is doing the math and understanding the scenarios. Oh, you own a rental property. Well, why don't we refinance the rental property? Because you probably can write off the interest rate or the interest cost, right? So even the decision of which property are we talking about is a huge decision. And sometimes people say, oh, my mortgage is up for renewal. but we should be talking about another property potentially. Absolutely. And you know what? Transparency, and I'll tell you something, Michelle, I have a funny saying. I want my clients to tell me everything. And if you don't tell me everything, I have an amazing staff member. He's my senior underwriter. His name is Hugh. And he worked at TD Mortgage head office for many years. He worked at Manulife head office for many years. So if I don't find what you're hiding, Hugh will find it. And if Hugh doesn't find it, we're going to send it to the lender and the lender will find it. And if the lender doesn't find it, the lender will instruct the lawyer and the lawyer will find it. And the farther down this path we go, the more it's going to blow up in our face, and not in my face, in the client's face. Because if they find out something, for example, oh, I'm tearing the house down and it's not really a mortgage, I'm tearing it down. Well, you've now destroyed the bank's collateral. If you tell that to the lawyer at the closing table, your whole file is going to blow up. So transparency is key. Yeah. So it's better for me to find stuff out than for the lawyer to find stuff out on the closing day. Yeah, thank you. That the CEO, his name is Rich Fairbank. I mean, one of the best CEOs ever, just like simply put. I'm going to briefly do a case study that I'm working on, and then I'll open it up for questions. But I have a divorced mom. Her mortgage is up for renewal right now in about 3 weeks. She has some car loans and credit card debt. Her payment on her renewal is skyrocketing due to higher rates. She locked in her original mortgage at around 2.99, and now they want to renew her at like 5.69 or something. And she's got a lot of equity in her home, but only modest income. So the solution was to refinance her, use some of that equity, get one simple payment. I wiped out her $700 car loan. I wiped out her 20% credit card interest. She's got one payment and rate a month. And it's less stressful and it's more organized. And I'm going to tell you something funny. And I gave her a little bit of money for some peace of mind. Now, I'm going to tell you something funny. We're done here, but I'm going to tell you guys something funny. So what's the funny thing? The funny thing is that the mortgages that I get the most job satisfaction on a personal level is when I help out people like this divorced mom. And the reason why is I am changing her life. I'm de-stressing her. I am helping her on the road to recovery, and I'm setting her up for success. I love doing mortgages for, a surgeon married to a law partner who each make $500,000 a year and help them get a better rate. I certainly help. I love that, but it's much more personal, when I can help someone who's literally struggling to live their life. So it doesn't like sound obvious, but refinances are actually some of the most rewarding work that I do as a mortgage broker. So that's kind of my summary. So you were asking how she requalified for a refinance. So again, really good question. And I'm going to give you an interesting answer here. Give me 1 second. That's a really good question. Oh, what am I doing here? 1 second. I'm going to add a bonus slide right now to answer that question. This is one of my famous slides. One sec, guys. Here we go. This is one of my favorite slides. It's a little bit of self-promotion, but it's also the truth. So when you walk into a BMW dealership, what are they going to sell you? They're only going to sell you a BMW. They're not going to tell you that Audi is on sale. They're not going to tell you that a Jeep is better for your cottage. They're not going to tell you that a minivan is better for carpool. Whereas a mortgage broker really doesn't care what you choose. Tesla is more fuel efficient with electricity, Ferrari is more exotic, whatever you want to say, and then the client makes the decision. But the answer to the question is, mortgages on the surface look like they're all the same. A mortgage is a mortgage is a mortgage. But the answer is, some lenders care more about equity. Some lenders care more about income. Some lenders care more about interest. Some lenders hate self-employed. Some lenders love self-employed. Some lenders hate rental properties. Some lenders love rental properties, et cetera, et cetera. Now, I use this car analogy because, again, that lady, that divorced mom, she didn't have a lot of income, but she had a lot of equity. She had good credit. She had been stable income for many years, and that made the lender comfortable to lend the money. Whereas if I would have gone to another lender, they would have said, yeah, she doesn't make enough money, like no chance. So that's kind of the answer to the question. Good question. But again, that's why we work with so many lenders. Any other questions? Okay. I'm going to stop the recording. I don't know if Mark wants to, I'm going to stop the recording.